that the paper market is ending along with the fiat currency system. And this ending of the paper market is not going to be a simple wind down at all. No, I think it's quite likely to create crises of delivery, which I wouldn't want to be. I wouldn't want to have counterparty risk in the paper markets at all. And if the bullion paper market has problems, then you can imagine that that's central to virtually the whole of the derivative industry. Not directly, but indirectly. Because, of course, the people who are playing the paper game in gold are the same people playing paper games in other derivatives. The same players, the same hedge funds, the same banks. So on that basis, systemic risk in the gold market is actually a very, very serious issue.
You're watching CapitalCosm. My name is Danny. It is July 3rd, 2025, and my guest today is fan favorite, Alasdair Macleod. Alasdair, thank you so much for making time on the show, my friend.
My pleasure, Danny.
Yeah, let's just dive right into it, Alasdair. What do you think should be on the radar screen for investors right now? What's your main focus right now?
My main focus is the debt trap, which every major economy is going into. And by major economy, I really mean virtually all the members of the G7. This debt trap is now going to become an issue. Why? Because each economy is now beginning to contract. I mean, I think they've been contracting for some time. If you take out the artificial stimulus to GDP of budget deficits, take that out, and you've got a more accurate position, if you like, of the private sector. That private sector portion of GDP has been contracting in nominal terms for a while, particularly in America, all covered really by all this excess government spending, if you like, funded by the creation of debt. Now, when an economy starts contracting, then the taxes that basically cover the interest on the debt start contracting as well. So you have a situation where the debt is growing faster than the economy. That is classic definition of a debt trap. All that is required is for people to realize it. And the people who realize it first are obviously foreigners. If we look at the US economy, foreign ownership of dollars and underlying assets is a short $40 trillion. And that's according to the US Treasury.
Wow.
40 trillion.
Amazing.
The way that breaks down is sort of, I haven't got the figures right in front of me, but you're looking at about 9 trillion in US Treasuries. You're looking at about 7 trillion in deposits, and you're looking at about 14.5 to 15 trillion in equity markets. The rest in corporate bonds and, similar sort of stuff. So from a foreigner's point of view, they're looking at the dollar and saying, the dollar's going down. The president is, saying that Powell is an idiot and we've got to get rid of him. And we need to get interest rates down. And it's Powell's fault that they're not lower. And he's also saying, I want the dollar lower. The dollar has already fallen on the trade weighted from 110. I think that was more or less April the 2nd, Liberation Day, as he called it. Expensive day as far as the foreigners are concerned. It's fallen from there to around about 96 and change. So already the foreigners are losing more on the foreign exchange than they can be possibly making in any of their underlying dollar investments. That is not good. I see no reason why they should continue to hold the dollar, unless in the unlikely event they think that, oh, don't worry, things are going to turn round and, you're going to get lots and lots of agreements on trade. Because remember, it's the 8th of July, I think, was the deadline for all these negotiations on tariffs and so on. Now, come on, I don't really see that there is any optimism as far as foreign owners of US dollars and underlying financial assets are concerned.
Is that why we're go ahead?
Go on.
No, is that what we're seeing sell off in the DXY?
Yeah, I mean, this is, I think, I mean, DXY, the acronym DXY stands for, just for the sake of viewers, Danny, and me, is the DXY is the trade weighted index. Yeah.
Yep.
Yeah, you got it there, I think.
Yep.
That's the dollar index. Yeah. Yeah,
so
that's it. The dollar index. That's it. Yeah. That's going down.
Yeah, since January of this year. So it's you've had these 1, 2, 3, 4, 5, 6 massive red candlesticks on the DXY.
That's it. And if you look at the moving averages, you know, you've had a death cross, and they're going lower. That there is no doubt. So, from the foreigner's point of view, you know, they're sellers. They're natural sellers now. And of course, this gives a problem to the US government when it comes to funding US Treasury debt. Now, they do have an answer. What they want to do, basically, is to reduce the supplementary leverage ratio on the big banks. And there was a discussion in the Fed, which was actually a public discussion, with the compliance officer, who's a lady, saying, you know, Basel III, it should be all right, and all the rest of it. The point behind that is that it's going to create balance sheet space for the banks to subscribe for yet more US Treasury debt. Now, quite clearly, the Fed realizes that it's got a problem amongst the foreigners, and it would have to be asleep at the wheel not to notice that, quite frankly. The problem is, therefore, that what are the banks going to buy in terms of Treasury debt? They're going to buy just short maturity. They're going to be buying T-bills. They're not going to be buying anything out along the yield curve, unless they're idiots. So on that basis, you're finding that the debt, US Treasury debt, is getting closer and closer to money, rather than being, you know, sort of long-term obligations. And it means that the rollover, the annual rollover, is just getting worse and worse and worse. And the foreigners can see this. The only foreigners who will buy US Treasury debt, for example, are the Cayman Islands insurance industry, which basically is offshore US insurance. And Luxembourg is another area where US institutions basically gather subscriptions, if you like, from euro, out of euro currencies at one rate, and lend them at a higher rate out to the US Treasuries. And they're about the only buyers in the market. So on that basis, I think that you're going to see the long end of the yield curve get more, you know, the yields go up. I think the yield curve will go even more positive. And I think the ability to fund out in the yield curve is going to be poor. The only way in which this can be dealt with, in my view, is to see higher interest rates. Because if the Fed lowers interest rates, which of course is what everybody's talking about, then that's just going to kill the dollar. You kill the dollar, you make the position even worse. Foreigners definitely start selling in greater quantities. So they've got a bind. The Fed knows it. Scott Bessent knows it. The only person who doesn't seem to know it is your wonderful president, President Trump. He is in complete ignorance of the situation. And that, I think, is extremely dangerous. And I can tell you that as far as the foreigner is concerned, they don't really rate President Trump as a president. They don't really have any confidence in him whatsoever. So that, I think, is the background to the way things are developing. I think as soon as you see the 10-year yield heading towards 5%, that's going to start undermining the equity markets if they don't start being undermined before then. And that's going to have very serious consequences. Because what we have here, Danny, is we have a debt bubble. And of course, if you've got a debt bubble, you've got a credit bubble. And credit bubbles go pop. And the last one that went pop, which looks just like this, was 1929 to 1932. 1929 was preceded by the Roaring Twenties, an expansion of debt and credit. And then we had the Smoot-Hawley Tariff Act shoved on top of it. What have we got? We got the same thing, except bigger. And we got Trump's tariffs being put on top of it. We can't quantify them yet, but we do know that this is screwing up global supply chains. And we do know that the economic consequences are to drive every recession, every economy, major trading economy, into recession. The only people who don't seem to understand this are Trump and his very, very keen supporters, who Trump can do anything and they'll still praise him to the skies. It's a disastrous situation. It really is. And a collapse, 1929, between September and 1932, the fall was 90% in the Dow. And the other thing that happened is you had 9,000 banks went bust. You're going to get financial difficulties because the way in which debt gets dealt with under these circumstances, particularly with rising long bond yields, bond yields along the yield curve, the only way that gets sorted out basically is by defaults. And the defaults are going to come thick and fast. It's going to be a very lucky bank that manages to navigate through customers defaulting.
Even if we do see Fed funds rate come down to maybe even as low as 1%, sub 1%, as Trump has alluded to, how would that impact the long end of the curve anyways? Because they've been trying to bring down the long end of the curve to no avail.
Yeah.
And it seems like there's a disconnect between the two.
Yeah, no, you're right. The long end of the yield curve would be, it'd be standing on its head. I mean, you won't be able to fund anything out along the yield curve. It doesn't matter what it is. It just become impossible. Because on a 1% Fed funds rate, what's that going to do to the dollar? It's going to collapse it. I mean,
But what happens if you keep interest rates at 4 to 5%? How are you going to be able to roll over the debt at that point?
Well, it's actually the right question to ask because either you die quickly or you die slowly. I mean, as simple as that. I'm sorry to say. I mean, I may be smiling at this, but Britain is in exactly the same position. I mean, it's slightly different numbers. I mean, we've got more of a European problem insofar as we can't balance our budget. To hand it to the UK Treasury, they do understand you've got to balance the budgets. And so the Chancellor has come under huge pressure to do that. She raised income taxes, not income taxes, but she raised various taxes on businesses, for example, and also the very wealthy. What's happened is that the very wealthy, I mean, we got something like the top 1% of income tax payers pay 30% of income tax. That 1%'s gone abroad now. They're not interested. We had a relatively friendly regime for wealthy foreigners. They would not have to pay tax on their foreign earnings. These were called non-domiciles, that was short for. They're all going abroad now. Why? Because the non-dom situation has been stopped. So what's happened is that, and I think we can see, we can imagine quite clearly that within the Treasury, they've been told by the Inland Revenue, HMRC, Her Majesty's Inland Revenue and Customs, His Majesty's, that the tax takes have gone way down and we have a problem. The result is that the Chancellor was advised by the Treasury, look, you've got to start, raising taxes is just making the situation worse. We've got to cut spending. So she goes to Parliament and tries to get cuts through on welfare. And there's a complete rebellion within the Labour Party. The Labour Party basically is elected to protect welfare. So the government cannot carry through cuts in spending. It just can't do it. So, where do we go from here? Well, there's a crisis. I mean, we actually had the Chancellor of the Exchequer, who's a lady, crying on the front bench in Parliament. I mean, can you imagine such a thing? It is a disaster. We've got a real problem. We really have. And if you talk to, go and look at France, they've got a real problem as well. So has Italy. I mean, Italy is sort of probably dealing with its problems slightly better, but really, and Spain is a huge mess as well. I mean, all the G7 members, one way or the other, are in these debt traps. You're finding their economies are going down. Their ability to service their debt is going up. Not that they ever service their debt. I mean, basically, they roll it into yet more debt. But this is just getting worse and worse and worse. It is the end of the fiat currency system. That's the whole key point. That's what we're seeing. We're seeing the death of fiat currencies. And it's going to be pretty unpleasant for all of us, I'm afraid.
What countries are in better straits right now relative to the West?
If you're looking for great deals on gold and silver, coins and bars from a company that you can trust, then you've got to check out the good folks over at Pinbeck. This year, I've really gotten to know these guys, and all I can say is you're not going to deal with a better group of people. They're a family-owned gold and silver online bullion company offering the essentials and more at industry-leading prices while always providing first-class top-tier service. That's Pinbex.com. And if you're looking to convert some or all of your retirement account into real gold and silver, give Pinbeck a call. They'll help explain the process and get you started on the right path. Your support at Pinbeck also helps support the channel. So reach out to Pinbeck today. You won't be disappointed. And make sure to tell them Danny sent you.
Well, obviously, the Asian countries, you've got China and Russia between them. I mean, we keep on saying that, the Russian economy is a mess and it's horrid. But I mean, this is propaganda. I mean, it really is. If you actually look at the Russian economy, it's actually in pretty good nick. The numbers are, take a little bit of getting your head round. I mean, they've got an inflation rate which is running at 8 to 10%. But yeah, I would ask you, Danny, what's our inflation rate? I mean, is it really 2.3% or 2.4%? It's probably closer to the Russian rate of 8 to 10%. But the difference is that government debt to GDP is not 120% as it is in America, close to whatever. It's 20%. And if you look at income tax, it's a flat rate of 13%. I mean, this is this is stuff we dream of. I mean, the only thing is you probably wouldn't want to live in Russia, but, they're doing the right thing economically. Now, the reason that they're doing this is they can afford to do so because they've got energy. I mean, the energy exports and all the rest of it, despite tariffs, all our tariffs and blockages and, banning Russian exports into Europe and so on. I mean, they managed to get around that. They're doing well. The Russians are reinventing a lot of their industries to replace what they've lost, if you like, from sanctions in the West. And meanwhile, of course, working with China, they're building a whole new world. I mean, if you look at the Shanghai Cooperation Organization and BRICS, and maybe just a few of the countries who, are sort of quite keen to join BRICS, you're looking at about 70% of the world's population. And on a purchasing power parity basis, we could well be sort of almost level pegging with that lot. And there are a hell of a lot of other countries who are ready to join BRICS the moment they feel that they're safe to do so. Because if they owe dollars, America will come in and screw them. If, on the other hand, they don't owe dollars, then they organize regime change. I mean, this is the way things have been working for decades, literally decades. So everybody's a bit frightened of America. I think that when American power starts diminishing, and the token for that is probably going to be the dollar, then I think the BRICS story is going to get a renewed momentum.
Yeah, I have the S&P relative to the world stock index here. So it's very interesting. that you mentioned foreign capital fleeing the United States. So the top chart is the S&P divided by the world stock index. And you can see this pretty strong underperformance over the last several months here. We did have a bit of a retracement back. The bottom chart here is the S&P priced in dollars. And as you can see, it's been making new all-time highs, but priced in the world stock market, it still hasn't recovered from its initial sell-off at the start of the year.
Yeah,
so much to your point.
Yeah, very interesting. Yeah, and I mean, certainly we've seen the London stock market has performed pretty well, but this is all bubble stuff. I think the most difficult thing is to call the top, because this is a momentum-driven market rather than a value-driven market, and it's global.
Right. Let's go ahead and take a look at gold. Gold is the confidence indicator for the entire system here. I know you had some juicy tidbits regarding the gold paper market. Before we get into that, what's your overall view on gold?
Well, the way I always look at gold is it's not gold going up. It's the paper currency, you're measuring it going down. I mean, it's really as simple as that. I mean, in dollars, remember that it was $35 to the ounce. That was the official rate when it went off the gold standard, the Bretton Woods agreement. And we're close to 1% of that now in terms of the dollar's purchasing power. That's actually what's been happening. In the case of sterling, I mean, we've got an even longer history, because before the First World War, you could exchange one paper pound for one sovereign. The sovereign now is 600 paper pounds. What's happened? Has the sovereign gone up? No, it's the paper pound going down. It's a far better measure of the loss of purchasing power of a currency than, say, the consumer price index, which gets fiddled, as you know. So that's the way I look at it. And I see the dollar is going to continue to go down in terms of its purchasing power. It must do. It's certainly not going to recover. I mean, any recovery would be extremely short-lived.
And what do you make of you had some comments off screen for me regarding the paper market for gold and some of the disconnect that you're seeing there. What are some of the latest insights that you're seeing on that front?
Well, that is a fascinating story. So far as I was aware, until fairly recently, I was the only person talking about the stand for deliveries on COMEX. They are absolutely massive. And funnily enough, I was looking at these numbers the other day. I mean, up to now, from Liberation Day, April the 2nd, the amount of gold that's been stood for delivery is about 250 tons. Mm-hmm. 250 tons. And the interesting thing is that since that time, the warehouse stocks have contracted by almost exactly the same amount. Now, I think there's a degree of coincidence in there, because there are leads and lags in terms of stands for deliveries and actual withdrawals from the warehouse system. But it's these stands for deliveries which are important. So let's go back a little bit. When we go back to the beginning of this year, you saw big premiums on COMEX. And these premiums came about because there was a concern on COMEX that President Trump would introduce 25% tariffs on everything, because that's what he said he would do, basically. And so they thought, well, gold and silver, okay, we have got these stands for deliveries, we've got these obligations, and we've got to make sure we've got the cover for it. So you can see that this led to a substantial premium on the futures. That created an arbitrage, if you like, between COMEX and other centers, whereby physical gold was moving from other centers, principally London and Switzerland, but even Mumbai was involved in this. You know, effectively the bonded warehouses in Mumbai were funneling some of their gold over to COMEX as well. This is a substantial move. Not only that, but this stuff was coming out of the Bank of England. Now, the Bank of England does store some gold on behalf of commercial entities. By that I mean, either bullion banks or large funds or whatever. But this gold is basically leased gold, which is under the temporary ownership of bullion banks, and operators, if you like, in the London bullion market in London. So, this is gold which has got to be returned. So huge numbers have left the Bank of England and also the LBMA and gone over to COMEX. Now, I would guess that what's happened is that the arbitrageurs have covered the price risk in the papers market. I mean, they must do. It's quite simple. The easy way to do it is basically you buy out of the money calls or something like that, and working that sort of derivative, you put a cap on your potential losses if gold continues to go up. Meanwhile, you look forward to the opportunity of closing your arbitrage, because this isn't just a one-way trip. They don't own the stuff really. I mean, they only temporarily own it, so they've got to get it back. Now, if it's being delivered out of COMEX vaults and stand for deliveries, then where's this going to go? How are they going to get this gold back? That's a big, big question. Now, I've been the only person, to my knowledge, really sort of pushing this line as an explanation for what happened. But then about 3 weeks ago, we had something from the ECB, because the ECB was concerned about the increasing level of derivative exposure in precious metals and particularly gold as a result of what happened. And they described exactly what I said. They said that gold was going over there. You had stands for deliveries in COMEX, and the gold has effectively disappeared. But what's happened is that Eurozone institutions have increased their paper derivatives by 58%. In other words, the coverage isn't physical, it's just all paper. Now, so we had the story confirmed by the ECB. I think that's a very, very important point. It's not just me shooting off in the long grass. So how do we get this back? It's gone. We don't know who stands for delivery, but we're pretty sure that these are hoarders, not traders. I mean, I was listening to someone. I think it was probably someone like John Reed or someone from the World Gold Council, and he was assuming that the rise in price would create the profit opportunity, which would bring the stock back into the market. By stock I mean physical bullion. Mm-hmm. No, and the key to this is to understand these aren't traders buying gold. These are people getting the hell out of fiat. They're not going to get back into fiat. That gold is gone, vanished. It's not coming back.
And these players, I mean, how big are they? Are these individual billionaires or are these governments?
Well, we don't know the answer. I would suppose that they are smaller central banks. I think they're sovereign wealth funds. And I think they're the super rich in Asia, of which there are now many, 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 many ultra high net worth in families. So I think that's where it goes. I mean, a long time ago, I was reading about one Egyptian guy who was trying to get his way out of, the Egyptian pounds, which was sinking like a stone. And he was putting something like $1 billion into physical gold, or 2 billion or something. I mean, you don't need an awful lot of that sort of demand to clean out the market. There is no real physical. I mean, okay, you and I can go in and buy a few coins or small bars or whatever, but you really want to take, delivery of a couple of tons. Ooh, join the queue. This is not something that's going to happen easily. So the point is, let's go back to the problem. The problem is that a central bank, which had its gold stored at the Bank of England, has so far been quite happy to lease it out to help pay the costs of storing it at the Bank of England.
Mm-hmm.
And the Bank of England has been very happy to act as agent for it and saying, well, you don't worry. It sort of, it'll remain in our vault. So we've still got control over it. Yeah, like hell, it's gone. So what does the central bank think? And I'm talking about, sort of like the Central Bank of Finland, for example, who did disclose that they had something, I think it was something like 60 tons in the Bank of England. This was quite some time ago. And they made a big error by telling me that they were leasing half of it. And then they went quiet on the whole thing. I had a Finnish friend who gave me the translation, so on. So, okay, you're the Bank of Finland. You're sitting there, you're thinking, God, our gold's gone. What are we going to do? It's a quick call the Bank of England. Where's it gone? Well, the answer basically is that you're not going to do any leasing ever again. And probably you're going to turn around and say to the Bank of England, hey, come on, we want it shipped back to us. Just like the Bundesbank did to the Bank of New York, about 10 years ago? The Federal Bank of New York, 10 years ago. Now, this is desperately important because the liquidity in the paper market depends on this leasing game and the rehypothecation of leased gold. And it's a circus which is run by the Bank of International Settlements and also the Bank of England and also the New York Fed. They have lost their liquidity and there's a hell of a lot of gold gone missing. So how do we sort this one out? I mean, the answer basically is that the paper market is ending along with the fiat currency system. And this ending of the paper market is not going to be a simple wind down at all. No, I think it's quite likely to create crises of delivery, which I wouldn't want to be. I wouldn't want to have counterparty risk in the paper markets at all. And if the bullion paper market has problems, then you can imagine that that's central to virtually the whole of the derivative industry, not directly, but indirectly. Because, of course, the people who are playing the paper game in gold are the same people playing paper games in other derivatives. The same players, the same hedge funds, the same banks. So on that basis, systemic risk in the gold market is actually a very, very serious issue.
Does this mean that what you're saying will trickle down into other commodity markets as well, separate from gold and silver?
I think it's bound to, because all these markets are basically priced on the back of derivatives. If you can't hedge, let's say your copper or whatever because of counterparty risk or whatever, then obviously it's going to have an impact on underlying prices. It must do. I would think it would lead to relatively immediate demand for virtually all commodities, because the point about derivatives is that you can have a derivative without actually having to own the stock. So you can always use derivatives to protect your price ahead of delivery or ahead of a commitment. But when you can't use the derivative anymore, then you've obviously got to go out and get the stuff in because you're going to have obligations, if you like, on the other side in terms of delivering product. Whether it's mild steel or copper or silver or lithium or whatever it might be. Yeah, and also oil too, energy. That actually could be a very, very big consideration.
We saw something like that happen in 2022 with the nickel market, didn't we? When nickel they lost control of the nickel paper market.
Yeah, that was a rather different situation. The problem there was the incompatibility of the delivery on a contract. You had some Chinese business, which was a very, very big dealer in nickel, but they couldn't deliver nickel in the form in which the contract was set. So in other words, they defaulted on the contract. It's the problem that any market has, acting as an intermediary between different parties, is that the market itself takes on the counterparty risk. You deal with the LME, and you sort of, you're guaranteed by the exchange, as it were. But that only happens to the extent that the LME can actually deliver on its obligations. So it has this protection in its own rules that it can, under certain circumstances, cause contracts to be cancelled, which is what it did. And obviously, quite a few people were upset about it.
All right. I want to get your thoughts before we wrap up here on platinum. Platinum has been making some serious moves the last several weeks. Let's pull up a platinum chart here. Okay, so this is a very long-term chart. This goes all the way back to the 1980s. You can see platinum at some point made a high of 2,300 back in 08. I believe this was higher than the gold price at the time.
Oh yeah, yeah.
And today we're sitting at 1383. Let's go ahead and take a look at the daily chart. So daily chart, here you go. So here's this big move in platinum that we've seen recently. What's your take on platinum here, Alasdair?
Well, I don't actually follow it too closely. In fact, I hardly follow it at all. But what I would say is that the price has been in the doldrums for an awfully long time. I mean, as you can see, going back, it's a very, very important metal. I mean, it's important from the point of view of exhausts. What we call it, exhausts. I can't remember what you call it in America. The tail end of the car, as it were.
Yeah, the exhaust.
Catalysts, anyway. Automotive catalysts and things like that. It's, I would guess that rather like the silver market, we've had a long period of lack of supply given the level of demand. And I'm not quite sure how this is sort of, sustainable in a sense. But of course, when things begin to break, things like that really do run. And I would think that there's a good possibility that a few people in the market have got themselves caught rather badly short. I mean, for example, I could imagine motor manufacturers may be sort of thinking, well, we can always get hold of platinum because the price never goes anywhere, and find suddenly that they're uncovered. So they've got to go in and buy and drive the price even higher. So I would, I can't see there's anything more than that. I mean, Palladium is the other one, of course, and they've been using Palladium a lot more in catalysts for motors, and that has been a lot more volatile. And the other platinum group metal, rhodium, I don't know where that is now, but I mean that was just completely unobtainable at one stage, and it was up at something like $14,000 an ounce or something. I mean, I don't know where it is. I haven't seen rhodium for an awful long time. But you used to be able to trade in rhodium, but basically there was none available, so there was no trade.
Wow. I mean, what happens when they do lose control of these commodity markets? Are we to see skyrocket? Are we to expect to see skyrocketing supply side inflation when that happens?
Well, yeah. I mean, obviously, you're going to find prices go higher. And it's interesting if you look at sort of the various commodity funds and so on and so forth. I mean, they've all been sort of breaking out on the upside, or tending to anyway. And I think that certainly does feed through. What it does is it puts a floor on prices, certainly of consumer prices. It squeezes industry very, very badly, and quite a lot of industry might even have to close down on it. And yes, it sort of front runs what's really happening to the currencies, because what do governments do under these circumstances? Well, if you get a sort of commodity prices driving prices up, you can't possibly have voters doing without. So you print the money one way or the other for them to be able to buy things at a higher price. You're getting cause and effect a little bit sort of muddled here, but I think that's basically what happens. But I mean, it's the fall in the purchasing power, which is really behind it all. And of course, when you get a fall in the purchasing power of a fiat currency, it doesn't necessarily do it on an even, sort of downward curve. There are going to be moments when you get panics, which work against the currency. And you're going to get periods perhaps of the panic has passed and there's a little bit of stability. Like this summer, nobody's considering anything. And okay, the dollar's going down, but, the other side of that is the euro's going up, the yen's going up, sterling has even gone up. And you sort of begin to think, well, at some stage, these currencies, their purchasing power is really going to go down because the best currency in the G7, of course, the leading currency in the G7 and around the world is the dollar. And if the dollar tanks, if the dollar's got problems, oh my God, we've got problems. You get a cold, we get pneumonia. Some stage that's going to happen.
Yeah, but could it be a summer cold? I guess we'll see. We have to wait and find out.
Well,
Alasdair,
I would very much welcome a very light summer cold, a few sniffles and nothing more. But unfortunately, I think it would be wrong of me to present a case which, to my mind, has got no basis in evidence.
all right. Well, Alasdair, for better or for worse, it's always a pleasure having you on. Anything else you want to talk about before we wrap up here?
I don't think there's anything in particular. I did put a thing out on cryptocurrencies, well, particularly Bitcoin, which I would urge people to read. I mean, if you haven't made up your mind about Bitcoin and you're wondering, is this something that we should really take seriously or not? Subscribe to my Substack and read the article, and I think it will be very, very helpful. I don't aim articles on Bitcoin at the people who aren't going to listen at all, one way or the other. So this is really trying to educate people who really do want to find out. So I think that's we haven't got enough time to go into that, but I think that's something which is a very important point. I would just say that it correlates very nicely with the Magnificent Seven. So it's like a Magnificent Seven with no assets, no earnings, and in other words, it's got nothing in it at all. It's owned by the same people who own tech stocks, the Magnificent Seven. So lacking anything, all it's got is, sort of a concept and systemic risk. Those are the two things you've got to deal with.
All right.
Is the concept right? And, at the stage when Michael Saylor suddenly finds that things are going the wrong way for him, how's he going to deal with it? Interesting point.
Very good. Well, if you guys are interested in that article and for the rest of Alasdair's work, check out the Substack. We'll have the link to that down below for you guys to click on. Guys, thank you so much for watching. Alasdair, thank you so much for coming on. If you enjoyed this podcast, drop us a like and comment, go Alasdair, go, in the comment section. If you disagreed with anything, also let me know. I do, in fact, read the comments. Let me know your thoughts. Hit the subscribe button so you don't miss another video. Every little bit helps in helping this channel and this video get boosted in the algorithm. And finally, check us out on Substack. It's CapitalCosm. That's Substack.com. to get early access, ad-free versions, and uncensored versions for the videos that warrant it before the YouTube audience does. So with all that said, thank you guys for watching, and I will see you later.